reaction to some of the earnings out so far this morning. Let's bring in Cameron Dawson, Chief Investment Officer of NewEdge Wealth. Sometimes I'm thinking about, Cameron, if I was like on a diet and it was like, if I said I lost like 2 pounds, but year over year I'm still up 15, I don't, that's not, is that, and that's what I'm seeing here. A lot of these companies are beating expectations, but sales are down from a year ago. It's a tough operating environment, which I think you've pointed out for a while, to not be that bullish near term.
Yeah, exactly. It is rather unsatisfying. And if you do lower the bar and then jump over a much lower bar, of course, stocks can go up for a short period of time. But I think the question is, what is the message underlying on the global economy when we look at sales down, profits down for a lot of these companies? And a lot of the names that reported this morning are very cyclical companies like GM and GE, 3M. And so when you see profits or revenues fall, you do see profit lines really do compress quite a bit. So I think that what we're starting to see is signs of weakness within the global economy finally starting to show up within some of these names. I think the real standout one was UPS. They talked about how retail sales demand within the U.S. really drove volumes to be much lower, as well as the fact that they're starting to see much more weakness within Asia. So that points to a slowing global economy for sure.
I can remember, since we have you on quite a bit, I can remember saying, wow, Cameron, this market's doing pretty well, and you really weren't that positive. And then the next time you were on, it was like, wow, Cameron, the market came back down, and you were right. And then I did it again. Wow, Cameron. So now we're in the period, it's been doing pretty well. You're missing this. Are you feeling like you're missing it, or are you once again going to say you're going to get another chance, 4, 5, 6% down from here?
Well, we certainly are seeing momentum start to wane a fair amount, and we've bumped right up against, yet again, that kind of peak in valuations that we've been seeing really in every big rally that this market has staged, which is just shy of about 19 times. So we rally up to that level, peter out, lose momentum, and start to roll over again. But I would note, we are invested. It's not as if we're sitting on the sidelines. We stay invested in very high quality companies in order to ride out periods like this.
You haven't given us an all clear, anything close to an all clear, and I'm not saying you should, but what would indicate to you that it's an all clear, and when do you expect that?
So it is really important to get through this earnings down cycle process. And usually stocks do bottom when you're still in the midst of an earnings down cycle. So it's not as if you have to wait for earnings to rebound in order to be able to step in. But we think we still are in early days of really marking down earnings estimates. There's a huge rebound in earnings that's baked in, not just into 2024, but also the back half of 23. So we want to see those estimates really get recalibrated. And then it's a matter of time and magnitude. The fact is we'll be nearly at the 18-month mark of this bear market by the time we would get through the end of the second quarter. And so really that's at the point where once you've digested the bear market, you have a drawdown that looks close to above 25%. It's likely that your forward returns look much better than there. But we really do need to see this profit cycle start to work its way through, which we are just starting that process now.
You're mostly focused on the E in the, not necessarily the multiple at this point. I guess we know, or at least we feel like we know, that the Fed's almost finished. So maybe we can assume what the multiple should be. Then it's all about what you've been saying, the earnings trough, and when we get through that period and what really happens. You think, are we too bullish for 2024 or just too bullish for the second half of 2023 on earnings?
I think it's both. I think that what's one of the reasons why you've seen stronger markets year to date is this desire to look through earnings weakness in the very near term and turn our eyes to 2024. But that does ignore the fact that if you have 2023 starting at a much lower base, 24 numbers still look too high. And so when we put a $243 a share, which is where the street is for 2024, implying about 9% growth off of the 220 this year, if that looks more like 230, that gets you down to the 36 to 3,700 level, which is, of course, that October low, that we could see that retest as we kind of digest through that process.